All right, let's get right into it. The Indian insurance world is, well, it's getting completely shaken up. And right in the middle of this massive change, you've got two really interesting companies. On one side, the established giant ICICI Lombard, and on the other, the super-fast digital-first challenger, Digit. We're going to break down exactly how they're dealing with this brand new economic reality.
And yeah, we're not talking about small, behind-the-scenes changes here. We're talking about huge government reforms that have basically rewritten the rules of the insurance game. It's a real shock to the system, and it's directly hitting the price you pay for your car and health insurance. So that leads to the big question, right? When the ground is literally shifting beneath you, what do? We're going to look at the completely different playbooks of these two. You've got the market leader, basically trying to defend its kingdom, and the disruptor, who's out there trying to build a whole new one.
So here's how we're going to break it all down. First, we'll look at this big shakeup. Then we'll meet our two contenders, the Titan and the Disruptor. After that, we dive into the battlegrounds, the growth game, the whole motor insurance mayhem, and the profitability puzzle. And finally, we'll ask, what does it all mean for the future?
Okay, so what is this big shakeup I keep talking about? Well, it all comes down to a huge overhaul of India's GST rules. And seriously, this isn't just a tiny adjustment. It's more like a policy earthquake, and it was designed to get people spending again. And guess what? The insurance industry is standing right at the epicenter.
So how does this actually affect you? Well, the changes are pretty clear. For one, the GST on your individual health insurance premiums, gone. Poof. That makes getting covered cheaper. And if you're buying a car or a bike, lower GST rates mean the total cost is coming down. The whole point is super simple. Get more people insured and more vehicles out on the road.
All right, the stage is set. Let's officially meet our two main players in this story. You've got the heavyweight champ and the scrappy tech-first newcomer. And man, the difference between these two is just night and day. First up, you have ICICI Lombard. They've been around since 2001. They're India's biggest non-life insurer. I mean, a real titan of the industry. Then you have Digit. They're the new kid on the block. Started in 2016, and they were built from day one to be a completely digital company. It really is the classic experience versus agility showdown.
And when I say Titan, I'm not kidding. Just look at this number. ICICI Lombard's market cap is over 1 lakh crore rupees. That is just massive. We're talking huge scale, a giant customer base, and really, really deep pockets.
Now let's look at Digit. Their market cap? A little over 33,000 crore. Now don't get me wrong, that's still a huge company, but when you put them side by side, the difference in scale is just crystal clear. It really is a David versus Goliath situation. Except, in this story, David has some pretty serious venture capital money behind him.
Okay, time for our first battleground, pure, raw growth. In a market that's changing this fast, who's actually growing their business the quickest? The numbers here, well, they tell a fascinating story. Check this out. In the second quarter, Digit's gross written premium, that's basically their total sales, grew by a whopping 15.6%. They just blew past the industry average of 10.5%, and ICICI Lombard, they grew by a much more, let's say calm 3.5%. The big takeaway here is obvious. The disruptor is absolutely setting the pace.
All right, let's head to the main event, the biggest and toughest arena of them all, motor insurance. This is where the rubber literally meets the road for both of these companies, and believe me, their strategies could not be more different. So let's look at Digit's playbook. Sure, private cars are the biggest piece of the pie, but look at that. A huge 30% of their business comes from two-wheelers. That is not an accident. It's a very intentional, high-volume strategy to go after a massive part of the Indian market. Now, let's flip over to ICICI Lombard. It's a totally different picture. They're much more focused on private cars. That's over 54% of their mix. Their two-wheeler business is quite a bit smaller. You could call it a more traditional, maybe even a more stable approach. But why does this one difference matter so much?
Well, because that big bet on two-wheelers, it comes with a catch. A pretty big one, actually. Because of some tricky accounting rules for long-term policies, growing super fast in this specific area puts a ton of pressure on your short-term profits.
And this isn't just theory. Digit's own team put a number on it. They said they took an extra loss of 53 crore rupees in just one quarter, specifically because of their fast growth in two-wheelers. So why does that happen? Well, think about it. They have to pay their agents the commission for the entire 5-year policy right up front. But they only get to count the money they've earned, the premium, 1 year at a time. It's the ultimate trade-off, growth now versus profit now. They're making a bet on getting customers for the long haul.
And that leads us perfectly into our final battleground, the profitability puzzle. I mean, growing fast is great, but who is actually making money from the fundamental business of selling insurance? To really get this, there's one key number we have to understand.
And that term is the combined ratio. The easiest way to think about it is like a simple health score for an insurance company. It just adds up all their costs, so the claims they pay out, plus all their business expenses, and compares that to the money they brought in from premiums. If that final number is over 100%, it means they spent more money than they made. It's really that simple.
Okay, so let's put them head-to-head on this. GoDigit's combined ratio is 111.4%. That means, plain and simple, they're losing money on their core insurance business. Now, ICICI Lombard is also over 100%, but just barely at 105.1%. They're much closer to breaking even. And when you look at the actual profit after tax, the difference is just huge. Plus, ICICI has a higher solvency ratio, which basically means they have a bigger safety net of cash. This chart right here shows you the price you pay for that super aggressive growth versus the reward you get for being disciplined and stable.
So when you put all this data together, what do you get? What you see are two companies with totally different ways of thinking, two completely different philosophies. Each one is trying to find its own way forward in this brand new market.
And you don't have to take my word for it. Let's listen to what GoDigit themselves are saying. Their message is crystal clear. We're going to drive growth wherever we can find it. But they also say they're focused on core profitability, which is their way of saying they want to make money from the actual insurance business, not from other financial tricks.
And right after that, you hear from ICICI Lombard. In their language, it's all about being sustainable and thinking long-term. They're not as concerned with that explosive short-term growth. They're focused on building a business that's profitable and built to last. It's the tortoise and the hare playing out right in front of our eyes.
So here's the bottom line. It really boils down to two competing ideas. GoDigit's plan? Go for aggressive growth. Grab as much market share as you can, as fast as you can, and worry about making it all profitable later once you're big enough. ICICI Lombard's plan? Play it disciplined. Focus on profitable growth and use their position as a market leader to get sustainable returns.
And that leaves us with the one big question that matters. In India's insurance market, which is changing by the day, which of these two strategies is going to win? Will the future belong to the fast, aggressive disruptor who's trying to capture what's next, or will it be the steady, profitable titan who's built to weather any storm? The answer to that? Well, that's going to write the entire next chapter for Indian insurance.